Tuesday, December 21st, 2021, Monaco 64, home of alternative economics and contrarian views. So second video today, it's a rarity, 2 videos in a day. A lot of times, of course, I have to find topics to talk about, and it's not easy finding something every day and keeping people interested. So I played golf today, actually, after I did my morning video. I played 9 holes. Took me just over an hour. I played on my own, so very quick round. It's not very nice out there, the weather. It's winter tomorrow, first day of winter. It's cold, it's muddy, but it's just good to go and exercise a little bit. Okay, so what do I want to talk about? What is so important that I need to do a second video? Well, we're going to look at Turkey. The Turkish lira is actually risen massively in the last 24 hours. So the dollar has dropped. We have seen a total meltdown in the currency in the last month or so. That, of course, has led to higher prices in Turkey. Of course, the higher prices were there before the currency accelerated lower. But what you need to understand is once people lose confidence in the currency, like they did in Turkey, anything denominated in that currency becomes more expensive because you can only buy so much with it. It's simple. So really prices weren't rising in Turkey, even though they looked like they were. And even here in the UK or in the US, it's the currency actually that was falling. So how come the Turkish lira all of a sudden turned around? Well, I was speaking with my wife about this, and I told her, well, President Erdogan is just guaranteed Turkish savers that they would compensate for them if they hold their savings in Turkish lira for at least 3 months, let's say at a 10% interest rates. In case the lira drops more than 10% versus the dollar or gold, the Turkish treasury has said that they will compensate for them. So savers have rushed back into the lira, and this is only for individual savers. It's not for businesses or companies. So I explained it to my wife. My wife did work in the markets years ago, but sometimes it's complicated. So I found the analogy. Of course, it's for those people who are more familiar with markets and options. What Turkey has done, what President Erdogan has done, is written a free put option for savers. That's what he's done. And it has stabilized the Turkish lira. Well, in terms of going up versus the dollar, it's still very volatile, of course. So you can see that yesterday, $1 bought as much as 18.5 Turkish lira. And earlier today, the dollar dropped to 11 Turkish lira. So $1 could only buy 11. That's a massive move lower in the dollar, or move higher in the lira, if you want to put it another way. Right now, we're around 1273, which is still highly elevated compared to let's say September this year, when $1 would fetch 8 lira. Right now it fetches 1260 or 1270 or thereabouts. So who's gonna pay for all this? Well, it could end up being the Turkish taxpayer, because it's the Turkish treasury that will make sure that investors are compensated if need be. So I think it could be, it's still early days. It could be something that works for Turkey, for President Erdogan. It's all going to depend on investors' faith and confidence in the currency. If the lira starts dumping again versus the dollar, then this put is going to be exercised by investors, and the Turkish treasury is going to end up paying that bill. And of course, the Turkish treasury can't function without taxpayers. So some people are saying that this will help the wealthy and hurt taxpayers. It could be, but if the lira does stabilize, it could end up being a really clever move. It's still early days, as I said. So I'm going to read to you the article here in the FT talking about this. It came out about 3 hours ago. Turkey's currency surges after Erdogan unveils Lira savings scheme. Trading chaotic as analysts warn latest plan is a backdoor rate increase that could erode public finances. Yeah, I actually think it's a put. It's just like the Federal Reserve guaranteeing that it's going to keep doing QE to keep interest rates low. Erdogan is doing the same thing here. He's guaranteeing that he will cover the losses if the currency drops faster versus the dollar or gold than interest rates for savers. So let's go through this because there are some interesting points to listen to here, and hopefully for my viewers in Turkey, and I'm sure I have people in Turkey who watch my videos, this hopefully will help. Turkey's lira rallied in the second day of chaotic trading after President Recep Tayyip Erdogan unveiled a new savings scheme that analysts described as a backdoor interest rate rise that could erode public finances. The gains on Tuesday leave the currency up roughly 50% from a record low struck in the previous trading session. That was yesterday. The intense volatility was triggered by a new plan by Erdogan to lure Turkish savers away from the dollar and gold by compensating them for exchange rate losses if they held their money in lira. The currency was recently trading at roughly 1260 Turkish lira against the US dollar, having struck a record low of 1840 on Monday before dramatically reversing course. The swings on Monday were the biggest on Refinitiv records stretching back to the early 1990s. Rafet Gürkaynak, a professor of economics at Ankara's Bilkent University, described the new scheme as, in effect, a powerful interest rate hike. He said that it could bring stability to the currency, but warned that it could also have dangerous consequences. And I agree with him. It's a gamble, because if the Turkish lira were to drop again and go through yesterday's low, the Turkish treasury and the taxpayer are going to be left with a hefty bill. That was echoed by Wolfgango Piccoli, a Turkey analyst at the consultancy Teneo, who said that the move amounted to a stealthy rate hike and one that would be solely determined by the exchange rate. This huge exchange rate index interest rate hike means that taxpayers will be financing the wealthy so that they will not lose on their foreign exchange front. He wrote in a note to clients, adding that the scheme would place nearly all of the currency risk on the state. Well, you could argue that all the interest rate risk now for the US, for the UK, for Western Europe is all on the state as well, with all the QE that has been going on since 2008 to keep interest rates manipulated. So that's what Turkey is doing, but they're doing it with the currency. Erdogan, a staunch opponent of high interest rates, has ordered a succession of rate cuts in recent months despite double-digit inflation. Well, I don't think Erdogan is the only politician that doesn't like high interest rates. I think, yeah, interest rates got up to like almost 20%. So they're cutting from a very high level. Here in the UK, we have 7% RPI or inflation, and we have rates at almost zero at 0.25%. In the US, the CPI is almost at 7%, and you've got rates near zero too. So it's not just Erdogan. While the Turkish president has claimed that his new economic model will boost exports, investments, and job creation, it has put huge pressure on the Turkish lira. The currency has lost around 50% of its value against the dollar in the 3 months before Erdogan's announcement. An exodus of foreign investors from Turkey in recent years has meant that the pressure on the lira has been driven in large part by Turkish citizens and businesses reluctant to save money in lira, whose value has been eroded by soaring inflation and negative real interest rates. Let's just pause here. Does that sound familiar? It does. It does. So what's been happening in Turkey could very well happen in the US, in the UK. And you might ask, well, what would the dollar drop against if the dollar is the reserve currency? Well, it would be gold and silver, real money. The dollar is just a gold substitute, really. In the case of Turkey, you can see that it's not just the dollar that people have been going to, but also gold. They have flocked instead to the dollar and gold. That in turn has put further pressure on the currency. That's not me saying that, that's the FT. Let's keep going. In a bid to reverse the dollarization trend, or gold trend as well, I would say, Erdogan announced late yesterday, that his government would offer a new financial alternative to citizens that he said would alleviate their concerns about the impact of the plunging lira on their savings. The government would compensate savers, he said, for any losses if the decline in the exchange rate exceeded the interest rate offered by banks. From now on, there will no longer be any need for any of our citizens to switch their savings from lira to foreign currency, because they are concerned that the exchange rate may rise, the Turkish president said. And you could argue, well, that's not a free market. Well, it's the same thing that's happening to bond investors here in the UK and in the US and Europe. The Turkish Treasury said that the scheme would be open only to individuals, not to businesses, and that they would be required to commit to locking their money away for a minimum of 3 months to benefit from the exchange rate guarantee. While it provided no details about how the initiative would be funded, analysts voiced concern that the Turkish Treasury would bear the risk of compensating savers for any exchange rate losses. While Turkey's public finances remain strong compared with many other emerging markets, a foreign exchange component of central government debt reached 60% of the total in October. And I think the Turkish national debt is below 40%, so it's quite low, up from 39% in 2017. What they're talking about here is how much of the Turkish national debt, what component of that is foreign currency, of course. That means that each time the lira has slid against the dollar, it has become more expensive for the government to service its debt burden. Citigroup said that from the standpoint of the Treasury, the new scheme may turn out to be a more costly alternative to a tighter monetary policy stance in the event that lira deposits fall short of a depreciation. Deposit rates fall short of a depreciation of the currency and thus adversely affects fiscal performance. We believe these measures can bring temporary relief while the government tries to further implement its new economic agenda, said Luis Costa, a currency strategist at Citi, adding that the bank was scrapping its recommendation to bet on further Lira declines. So there you go. However, the scheme will do little to discourage Turkish savers from seeking non-Lira assets as a hedge against rising prices, he added. We do not see how that can fix the local currency asset issues in Turkey, which arise from the currency-led inflation, Costa said. So that's it. What I would say, though, is that if this works out, the inflation or the rising prices will probably come off a bit. They'll still be rising, but at a slower rate. It all depends how the Lira performs in the foreign exchange market. So there you go. Interesting move by Turkey and by President Erdogan, basically issuing a free put to investors, and only individual investors. In the US, of course, when the Fed or here in the Bank of England or ECB, when they issue puts, it's usually for hedge funds and the big boys. At least he's trying to help the people in Turkey. So there you go. If you have any questions, just go to the comment section and I'll try to answer as many questions as possible. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great rest of the day. Take care. Bye.